Through the last 4 videos, we understood what credit is, why is it important for our economy, and how credit is responsible for the increase of inflation. So, if credit and inflation are 2 key components for our economy, we need to understand how to bypass them and make it an advantage for us, so that our money doesn't lose value throughout the years. Hey, it's Dario and this is Divity Finance, a platform where we can share our best tips and tools when it comes to trading, investing or finance in general. And if you love the subject, please consider subscribing. Particularly in the last video, we said that the inflation goal of the central banks is around 2%. This value can in fact sustain the economic growth for a normal nation. We also understood though that this 2% translates into a devaluation of our money by 2% every year. In technical terms, we call this a loss of buying power. In a few words, our money is worth 2% less every year. To make it even easier, it's like if we had $100,000 and every year someone took away $2,000 from our bank account. The problem is that we cannot see it with our eyes, but this is not a good reason for the problem not to exist. So we need to find a way to get back at least that 2% every year. Through the last videos, we came to the conclusion that in most cases, the ones that ask for credit, especially for big amounts, do it with the intent of investment. In particular, we can take companies as an example. These indeed ask every day big amounts of money to put into investments. Of course, if a company invests money, means they spend it, and most likely the money has been given to another company. This money exchange makes company grow, makes the revenues grow, and earnings as well. This growth also increases taxes and finally increases a country's wealth. If only there was a way for us to enter this mechanism and take advantage of this economic growth. Fortunately, the way exists, and it's called investment in the financial market. There are various ways that allow us to enter the financial market, from the most direct methods to the less direct, from the riskiest to the less risky. The most important thing to understand though is that being a part of this growth is essential if we want to preserve our capital. So let's see some examples of instruments that can help us be a part of the growth. Probably the most famous and maybe even the scariest is the stock market. This allows us to be actual owners of one or more companies through the trade of company shares. If the company will choose wisely on how to invest their money, this will grow, and with the company we will grow as well. There are many ways actually to be a part of a company. The direct trade of stocks by choosing them individually is probably one of the most risky and complicated ways. There are funds though, or ETFs, that can help us. These are financial instruments which we will talk about in later videos. Another way we could choose to follow the growth of the single companies are bonds. These don't allow us to be owners of the companies, but it's simply a way that companies can use to collect funds to dedicate to their investments. If these investments will go well and the company doesn't fail, we will get back our money with a certain interest. Talking again about bonds, we can also use the growth of a country to grow and protect our capital. Countries, as well as companies, issue bonds. Countries ask for money so that they can invest in their economy. If the investments go well and the country doesn't fail, we will get back our money with a certain interest. Contrary to companies though, the interests for government bonds are far lower. This is because the risk of failing is much lower for a country than for companies. And in most cases, unfortunately, the interest that we receive doesn't even cover the inflation, so we are back at the starting point. Finally, there are also metals. Thanks to inflation, these tend to increase their price through time and maintain their intrinsic value. Metals, though, don't always guarantee a growth that, for example, we could have with stocks or bonds. Single stocks and bonds are pure financial instruments. These are directly issued by the companies or the single countries. There are some instruments though, such as funds, that can help us especially to increase diversification and decrease risk, maximizing at the same time the profits. An example are ETFs. We will talk about these instruments in later videos. For now, I'd like to share the importance of being part of the economic growth and the importance of not letting our money in the bank to be eaten by inflation. So, if you don't want to miss out on any further video, I highly suggest you subscribe to the channel immediately so that you can be notified on any new release. Lastly, if you enjoyed the video, please leave it a like. This is one of the few ways that I have to see if you like the videos and therefore keep posting. Nonetheless, I will see you in the next video.